So, Karan, once again, welcome to another episode of Talking Money.
Thanks, Santosh.
And today we are going to dive a little bit deeper to a subject that we had actually touched upon once in the past, but we all felt because a lot of people asked about the whole idea of generating passive income, right? Because passive income, a lot of times people, it seems like a buzzword, but what is the realistic or what is the right way to think about passive income, and what is a realistic way to even achieve passive income is what we are going to discuss today. So I want to start with a very simple but a very direct question, and that is, given that someone has, say, a overall corpus of 1 crore,
Yeah.
what is a realistic expectation in terms of what is the right passive income that one can actually expect from a corpus like that?
Thing is, realistic expectation should be, you can say 0.5% of the corpus every month.
0.5%. Okay.
It depends how you have deployed that corpus. If you have put it in real estate, you can expect 3% annual rental yield in India. That translates to roughly 25,000 rupees a month. Okay.
Yeah.
If you go for FD or let's say bonds and everything, okay, it can increase to 55,000 a month. Somewhere around, you can say around 7 lakh a year. Okay. If you have invested in equities, okay, let's keep the capital appreciation aside for a minute. Okay. So typically dividend yield in India is around 2%.
Okay.
In general is 2%. Okay. You can go into riskier segments. Okay.
Right.
In PSUs or maybe in metal mining companies. Okay.
Right.
That offer a pretty high dividend yield, but those are riskier segments relatively.
Yeah.
Okay. But broader market exposure, you can expect 2% dividend yield. Okay. So 2% translates to roughly around 18,000 a month.
Right.
Okay. There are some interesting options out there as well if you're ready to take more risk. Okay. So you can go for below investment grade bonds, okay, which offer a yield of around 12%.
Right.
Okay.
Right.
So that will make somewhere around 1 lakh a year. But that's
what does below investment grade means exactly?
So below investment grade basically means their ability. There is a doubt, there is a reasonable doubt that they would not be able to return the money. Return the principal. Okay. So if you are ready to take the risk, so there is investment. Typically, agencies like ICRA and CRISIL, they assign rating to the bonds.
Right.
Okay. So AAA is the best rated.
Correct.
Typically, you can see topmost financial institutions like HDFC Bank, ICICI Bank.
Right.
Issues from them are rated normally AAA. Okay. And then you go down AA, A minus. Okay.
Right.
When I say investment below investment grade, I'm talking about below AAA rated. Mainly.
Only that.
Okay.
Right.
So
those are not necessarily extremely risky either.
But there is a risk.
There's
a decent risk.
Right.
You can say some probability in single digits. Okay. You can go to A minus. Okay. So it's not exactly junk bond.
Right.
Go for microfinance institutions. Okay. Bonds issued by them. Okay. They can offer around 12%. Okay.
Oh, okay.
Then there are some other options as well, like REITs and InvITs. Space is quite small. Around 10 to 15 entities are there. Investment trust. So investment trust is also quite popular in US as a income vehicle. Okay. So the concept is basically these are the trusts which have some properties.
Right.
Okay. And a promoter typically create a SPV and transfer asset to that SPV.
Okay.
Okay. That SPV already is a operational asset. Okay. It already has long-term.
Just for people, SPV is a
special purpose vehicle. Okay. So it's goal of special purpose vehicle to manage that asset only. Right. Already long-term contracts are in place. Okay. So it's like kind of a rent seeking.
Correct.
Kind of a rent seeking on a commercial venture.
Right.
Okay.
Right.
So mostly it's popular for commercial real estate.
Yeah.
Okay. You have seen some REITs like Embassy, Mindspace. They have IT parks and all, and they've introduced those REITs are listed on exchanges as well. Apart from that, infrastructure trusts are also there. Okay. These, if you invest at right time, or let's say they are not spiking, we can say that they can offer yields of up to 14% as well, 14,
Wow.
15% as
Wow.
well,
Okay.
especially infrastructure REITs. The problem with these entities are, once you structure them as investment trust, okay, InvITs or REITs, okay, they are supposed to distribute 90% of their income as dividends.
Okay.
Okay. And if they distribute 90% of their income as dividends, they get the tax break from the government. Okay.
Okay. Okay.
Okay. So that's why dividends are quite high. Okay. But the problem with these trusts, as seen in US and Canada earlier, in last 10-15 years, you can say that these trusts are extremely risky. Their entire existence revolves around few assets, 1 or 2 assets. So if these 1 or 2 assets go bad, they are gone. They are bust. Second thing is that the dividend yield basically is built on the premise of regulatory reliefs. Okay. So we have seen in the past in Canada, like royalty trusts were quite common there for oil and gas exploration companies, and one fine day government took back tax incentive. Okay. So if tax incentive is gone, you can positively expect dividend to become half and your principal also to become half. Okay.
So these are the outlier risks that
which are there. Okay. So these are different options which are out there. But
so would it be right if I were to just very quickly summarize the various vehicles that you have mentioned, which goes right from, just buying a real estate and kind of having that on rent, to putting money in a more stable stocks in the equity market, to bonds, to REITs, to any of these kind of vehicles, and with a 1 crore corpus, investment corpus, somewhere around, say, anywhere between 18 to 25 or maybe even 30 is a reasonable expectation.
50 is also a reasonable expectation.
Even 50?
Even 50, 6%, you can do an FD. Okay. You can get some 7.5% on FD with a top-notch private bank or PSU bank. Right. Okay. So that will give you some 7.5 lakhs in hand in a year. Right. Okay. This translates to somewhere around between 50 to 60. Okay. So this is the decent option. But if you are willing to take some risk, right, you can take this income to even 1 lakh rupees or even 125 as
right.
well.
By getting into those slightly below investment grade, as you mentioned.
Yes,
bonds.
riskier slices.
Okay.
For REITs, REITs are relatively less risky, but their also yield is relatively lower. It's around 8%. Right. Okay.
Which is the typical relation between
risk and return. As you increase the risk, returns would definitely increase. Okay. So these are the different standalone options which are out there. Okay. But in general, if you ask me if I have 1 crore and what I would do, I would basically, I will not take any income for first year. Okay. And I would invest them in investment grade bonds. Okay.
For the first year.
For the first year. Okay. Maybe go for, take some bet in AA. Move away, some diversification away from AA, right, to get some higher returns. So first year, I will just invest them in bonds. Okay. From second year onwards, I will start taking out whatever principal is there every month. Right. I will start taking out 0.5% of that as monthly income. And gradually what I will do from second year onwards, I will introduce the equity exposure. That will be mostly in large cap and low vol side, low vol or dividend stocks on large cap side mostly. Okay. So some 10% exposure would be there. Okay. Step by step, I will increase it every year. Okay. In third year, I will make it 25. Right. 20. Then fourth year, 25. Then fifth year, 33. Sixth year, I will take it to 40. Okay. And there I will stop.
So the reason, and again, help us understand, why do you say that you will not take anything in the first year? What is the main reason for that?
See, thing is that we have to look for higher risk adjusted returns. Okay. So we have an option between an assured 7% return, with safety of principal largely ensured. Right. To take risk, to take exposure in the risky assets. Okay. So, and the problem with each of them is that there is no inflation component which is out there. inflation
Okay.
component is missing. So let's say I settle for 6 lakh rupees right now for first year. Okay, let's say. Okay, 10 years down the line, that would not be enough for me.
Correct. Okay.
I am assuming that I'm not adding any new principle. Okay, here. Okay, if you are adding any new principle, that's fine. So I have to basically increase the corpus, match the inflation. Okay, and but in a risk, in a risk controlled manner. Okay. So I will take the risk with equities, large cap equities or safer equity side. Okay, on an average, they have delivered 12% returns. Okay, and there's some level of tax efficiencies also there. Returns there are charged on charges LTCG and long-term capital gains and short-term capital gains. So there is a concession on the tax as well. Yeah, whatever income I'm getting, it will be charged on marginal tax rate. Okay, I'm assuming somebody's putting 1 crore there. They would have a decent, income at their disposal, and it would be belonging to 30% tax slab.
Okay. So would it be right to say that the reason why you would probably wait from doing any sort of withdrawal for the first
I'm now
year?
coming to your question. I actually missed your question while answering. So I would like to wait because I would like to reduce the risk of any market event. When you are taking equity exposure, there is always a risk of a market event. Okay. So in the past, I'm not saying it will definitely happen.
Correct.
But it has happened.
You have to plan for it.
A rare scenario. Okay. Like in 2008, you saw market went down by around 60%, broad markets. Okay. Even low vol slices were down by around 30-35%. Okay.
Even during COVID for that matter.
So I don't want to be in a scenario where I take a massive hit in very beginning, where I'm taking out money as well and I'm taking hit from the market. So I would like to create some cushion.
Some buffer, some
cushion, so that I can prepare for adverse market movements when I'm taking equity exposure. Equity is not safe. It's there. Equity is not safe. So what I would do for first year, I will not take any income. Keep 100% in bond. Let that buffer build. Okay. And gradually, as compounding, in second year I will introduce 10%. Okay. If it is down by 50% in second year, let's say in second year, so I am expecting a rebound next year. There would be a rebound next year, definitely. It cannot go down 50% every year.
Correct.
Okay. It will not work like that. Okay. So it will give me sufficient cushion to maintain my income. Okay. So even in the worst case scenario, when I am starting, I would be sitting at the same income. Okay. And gradually I will increase the exposure because the compounding impact would start kicking in. So 10 to 20 to 25, 30, 35, 40. Okay. You can also, once the, let's say corpus increase significantly. Okay. You have some cushion of 25-30% now on your original principal, even after taking out money. Okay. So you can also increase some risk. Okay. You can increase it to 50% equity exposure. Okay. Or you can introduce some mid cap or small cap component, some 5% component that you can add. Okay. Or you can add some InvITs or REITs. If you would like to add some 5% slice of InvITs and REITs that you can add. Okay.
So in a way, again, tell me if this approach is right. The whole idea of creating a passive income. The objective of that should be looked upon slightly different from a investment that you are hoping that it will appreciate, right?
See, thing is, if you're looking for passive income, if you are, let's say you are in employment, okay, and you're getting a decent, you have a decent income at your disposal every month, okay, then whatever happening to that particular slice of investment is of no consequence to you. Okay, you can take the risk. Even if market goes down by 20-30%, you can jump in. Okay, take the advantage of bottom. Okay, you can go for mid cap, small cap. You don't need that money. The problem with investment, mainly when you are taking the investment decision, first thing that you have to consider is when you need money. What is the cash flow schedule?
Correct.
Okay.
Correct.
Cash flow schedule is the most important. Okay, that basically give you an idea about the risk that you can take. Okay, and that build the foundation for your portfolio building and portfolio maintenance. Okay, so here you are talking about a passive income on which you would be dependent. Okay,
Yes.
you need that.
Right.
Okay, it cannot go down. Okay, you cannot it cannot happen that you can live without it for next 6
Right.
months. Okay,
Right.
there cannot be any gaps. You need it every month.
Right.
Okay, and ideally it should increase
Right.
over time to basically take care of inflation. Okay, so you need a you need a corpus. Okay, from which you are regularly withdrawing.
Right.
And you also want it to grow.
Correct.
Okay, there cannot be massive dips.
Right. Right. And just to highlight a few scenarios that usually people think of passive income in the context of retirement, but that is definitely one. But even for younger people, there are scenarios where, like, for example, in case you decide to start a company, there might be certain uncertainty in your income schedule because you don't really.
You can go for higher education.
That could be a career gap that you're planning. So there can be multiple scenarios in which passive income actually becomes part of your actual income. Like you said, something which you depend upon.
Kind of sustenance salary.
Sustenance
salary.
Yeah,
so,
right.
In general, if somebody is looking for, let's say, it depends how much they want. So, if somebody is looking for, let's say, 2 lakh of sustenance salary or 1 lakh of sustenance salary definitely cannot be 10-15 lakhs a month. Right?
Yeah.
So, it is sustenance.
Right.
Okay. So, let's assume it's somebody need 2 lakh, 2 lakh rupees. Okay. So, they have to first prepare 1 lakh 1 year in advance.
Right.
Okay, you can back calculate. Okay, 0.5%. So you're needing 4 crore. Okay, you have to prepare in advance. Okay, 12 months have to be there. 12 months runway you need to have. Apart from that 4 crore runway for 1 month, 1 year. Okay, and thereafter you can
for a sustenance salary of 2 lakhs.
2 lakhs. Correct. If you need a sustenance salary of 1 lakh, then it's 2 crores.
2 crores. Yeah. Okay, fair enough. So now coming to a little more, actionable point of this entire thing, which is, suppose if I want to build a passive income portfolio of around 2 lakhs a month, which is using that 2 crore, what should be the ideal mix of asset classes that I should go? I know you gave the examples of the various asset classes, but what I'm trying to understand is what might be a rule of thumb in terms of the pie chart with these asset classes.
The first thing is that you cannot lose your principal.
Okay.
Your principal cannot take a dip.
Right.
Okay. You don't have 3 years or 4 years or 5 years. You may remain invested for next 40 years.
Right.
Okay.
Right.
But the critical thing to note here is you don't have 1 year, even 1 year. Okay. You need salary every month.
Correct.
So there is already outflow. The compounding is already taking a hit. Okay. You're compounding already
because you're withdrawing.
Yeah. So you start with 100% debt allocation. Okay. Gradually we'll start moving towards equity. Okay. Year by year, you can increase as you get more cushion, you can take more equity exposure.
Right.
So with cushion, it increase. Okay. And you basically create a buffer. Okay. Every year you will create some buffer and you will increase the equity exposure. That will take care of any equity drawdowns. And as equity exposure is increasing, there you can introduce more slices. Okay. If you want to add some gold to the mix, you can add gold. You can go for REITs and InvITs, maybe 5% exposure to them. Okay. You can take some isolated equity bets in dividend stocks. Okay. But I will still suggest, that's my opinion, that exposure should not be more than 10% of your overall portfolio to these classes. Okay. So there you are trying to get additional income.
Right.
Okay. You are trying to increase the income. Increase the income. Okay. Add more to the compounding. So it's like some people come when you have a long-term portfolio in general. So people ask me, okay, should we take Bitcoin? So I always say that, okay, you can definitely take 5%. 5% exposure you can take to Bitcoin, 2%, 5%. Okay. If it really become 3 times, let's say in next 1 year, okay, it will still have a critical impact on your portfolio.
Yeah.
And if become half, it will not be much of you can minimize the risk in that case.
Right.
Okay. So here also, if you want to move on to increase the returns by moving in, let's say, below investment grade bonds, yields would increase. There are
Right.
always bonds which are available with C rating or D rating. Okay, risk would increase.
Right.
Okay, P2P. I'm not recommending P2P. I'm just giving example of high risk investments that can give higher income, higher risk. Okay.
Right.
REITs and InvITs are not that risky, but they're still risky because of single asset risk. There's massive asset risk which is there.
Right.
So usually exposure should be around 10%. Should cap at around 10%. Once you get, even if you're going for InvITs and REITs, try to diversify. There are around 15 InvITs and REITs which are out there.
Okay, even within the category.
Within the space, try to diversify.
Okay. So then would it be right to, conclude this point by saying that what you're essentially suggesting is start with 100% debt allocation, because the first principle of a passive income portfolio creation is complete safety of your principal corpus, right? Post that, you may try and increase the overall returns that you're getting, but it should be done in a manner where, in case there is a drawdown for that higher risk that you're taking, it should still not impact your invested corpus. Right?
There should not be a massive churn should be avoided to the extent possible. Apart from the asset allocation shifting, okay, which typically ideally should be done at the end of the year.
Right.
Or I will say annually.
Okay.
One time annually.
Okay.
You can pick the month.
Right.
Okay. Apart from that, no additional churn should be done.
Okay.
Because you are not going for returns.
Yes. The objective here is
churn makes sense. Churn create tax liabilities. Okay. It's brokerage cost, transaction cost, taxes. Churn makes sense when you're going for returns. You are not going for returns here.
Correct.
You are going for inflation adjusted principal enhancement.
Right.
Okay. That's what you are going for.
Yes.
And drawing the income, getting income streams from there.
Right.
Okay. Unnecessary churn should not be done. If you see a market condition, okay, let's do the churn. Just keep it once in a year.
Right.
Okay.
Right.
Don't go beyond it.
Okay. Now, and over time, suppose if I'm planning on having this passive income stream done over the next 10, 15 years, over a much longer timeline, what is the maximum, do you think, from a conventional logic point of view, that I can hope to increase my returns? Like, what is the maximum share of the slightly higher risk asset classes that I can go to?
See, if you let's say you are 10, it's not about the horizon.
Okay.
It's about where you are in journey. Okay.
So tell me what is the difference.
So if you are in fifth or sixth year of investment, you are there at 40%.
Okay.
So now the compounding would kick in. Okay, for next 5 years.
Right.
Okay. So it will create additional buffer for you. Your corpus might double.
Right.
Corpus might double actually. Okay. So there you can increase the equity exposure.
Right.
You can go for you can increase up to 50%. Maybe in some cases 60%. Okay. As well. Large cap and mid cap come into play. Okay. The thing is that equities can have a drawdown of 50%. That's a reality. Okay. InvITs and REITs can totally go bust. Okay. If that particular asset become useless, okay,
right,
or the contracts that you have, the people they default on those contracts, okay, they can totally go bust. Okay.
Right.
Like PSU banks some 12-13 years ago. Okay. So there is always so you have to think about the risk that you are taking. Think about how much drawdown you can have. Okay. And what would be the impact on your portfolio? Okay. What is the hit in terms of principal that would be there? Okay. So higher the cushion you have, higher risk you can take. So risk taking capability typically increase over the time. Okay. So it doesn't matter if you are building portfolio for 40 years or 1 year.
Okay.
Frankly speaking.
All right.
Okay. It doesn't matter. Investment horizon doesn't matter because your investment horizon is 1 month.
Correct. Okay. That's a very interesting perspective.
So
yes.
Investment horizon is 1 month. Investment horizon is not 40 years.
Right.
As you go into 5th year, 10th year, 15th year, 20th year, definitely you can increase your risk.
Right.
Okay, you can go for higher risk, and you can increase mid cap, small cap,
Right.
low grade bonds, maybe Bitcoin.
But when it comes to passive income, at any point in time in your journey, what matters most is your principal preservation and your sustenance income that you're reliably generating every month. That is the main.
Yes.
Okay, so that was thanks a lot, Karan. I hope really
Santosh.
people found this useful and actionable. For the benefit of people, we have actually created a very simple Excel template, which might give you some idea in terms of what would be the right corpus for you to create a passive income with, depending on whatever sustainable income that you're trying to generate and what might be the right asset classes for it. So it is just a exercise for you to kind of get a sense of it. It is by no mean a very detailed financial explanation for your lifestyle. So I hope you found that useful. If there are any further questions or any other topics like this that you would like us to cover, do let us know. And once again, thank you for watching. Thanks a lot, Karan.
Thanks, Santosh.